All right, let's head to the markets now. Will is not in Davos. Will is not in Davos, but a lot of things happening.
This is my hologram.
Oh,
okay. I'm actually in Davos reporting the market like so. This is a hologram.
Oh,
and you need to recognize artificial intelligence when you see one.
I apologize.
Yeah, so I'm very well, and great to report the markets as usual. We saw very great news from the equities market, especially in Africa. We see Nigeria's NGX. Very quickly, let's look at that. We see markets trading not badly at intraday. We quickly have that on the screen. Yes, 0.19% for Nigeria's NGX. And we see that rebound from yesterday's trading session. You know, we had that 0.29% downtime yesterday. But we see also in GSC on the flip side, in the red at intraday, 0.66%. Let's look at Egypt. Let's see how they performed in today's trading session. Egypt is, however, also up at intraday 0.45%. And we see Kenya's stock market closing in the red after, successive days of positive closes. Right now, they're beginning to, feel the pinch. I think their debt profile is beginning to impact, investor sentiments there. So 0.08% for Wednesday's close. Let's see how today turns out. But before we delve into the Middle East, let's just turn our attention briefly to the fixed income market. We had that NTB auction yesterday, that's Treasury bill auction in Nigeria, and the results are out, and total offer we saw was about 530 billion naira. And there was an oversubscription, settled at 755, over 755 billion naira was sold by the central bank yesterday. But Caleb Alimi, chief dealer, Providence Bank, joins us virtually with more insights into this. He's going to give us what happened and break down these details. Good afternoon, Caleb. Caleb, I just want to know very quickly, if you can hear me, what does the oversubscription tell us about liquidity levels in the market, especially when we compare it to this same period last year?
Thank you for having me, Will. Good afternoon. The oversubscription, largely about liquidity, just tells us market is a bit more liquid. It doesn't say much about, whether investors are really interested in the paper. And what we find is that you found that the range of bids was from 21% to 28%. So a lot of those bids could have been above 22, 23%. For DMO to have sold over 700 billion and still kept the rates low compared to the last auction, it shows that it wasn't really a liquidity play, it was a demand kind of thing. We had a lot of demand, but at a lower level. Compared to this time last year, it also shows that the DMO is ahead of its borrowing program. This time last year, they had raised just roughly around 288 billion, just under 300 billion, as at two auctions into the year, and they have raised it at a maximum level of around 11% or 11.5 or thereabouts. However, this year, they've raised over $1 trillion, and they've done that at a maximum rate of around 22%, 22.6%. And that's largely because, last year as well, between January and December, the monetary policy rates, MPR rates, moved from 18.75 at the beginning of January to 27.5 at the end of the year. So that all of that has played into where we are today, as in terms of interest rates and in terms of expectations of customer appetite for treasury bills.
Okay, so seeing what the CBN has done in terms of MPR, how does it yield on T-bills compared to other fixed income instruments? And what impact does this have on investor behavior right now? You said not much appetite, but we're seeing this oversubscription. How does this impact on investor behavior?
Well, investors will continue to invest their monies in these instruments. We call them risk-free instruments. How do they compare to other fixed income instruments? You're talking about maybe commercial papers from the private sector, and then government bonds as well, which are the longer end of the curve. Compared to commercial paper from the private sector, obviously there has to be a premium on the risk-free. So it is lower than what commercial papers are offering from other corporate borrowers, obviously because the federal government instrument is seen as a risk-free instrument, and then there's a risk premium that investors would demand when investing with other private sector individuals. Compared to federal government bonds, obviously the long end of the curve is also now trading interestingly around the short end of the curve. So the curve is some sort inverted, where you have 1 year treasury bill doing a yield of 26, 27%, and then you have a 10-year bond also yielding about 21, 22%. So you have an inverted yield curve. And that simply tells us that a lot of people are betting on the now versus the future. So they rather just take their bets now for 1 year, watch their investments, rather than go lock into longer term investments.
Okay, since we now have this inverted yield curve, do you expect yields on Treasury bills to rise or fall in the near term, given the current borrowing environment is quite aggressive by the federal government?
So yes, first of all, the deficit this year for this year's budget is larger than the initial deficit for last year's budget. Last year's budget started at an initial deficit of about 8 trillion. This one has started at around 13 trillion. So clearly there's a larger appetite to borrow. However, we also still expect that should there be a revenue target miss, the government will have to borrow much more. However, what we have this year that we don't kind of have last year is the stability in the FX rate. FX rate has stayed around the 1,500 handle, 1.5 handle for a while. But we didn't have that last year. Last year we had a lot of hyperventilation or hyperinflation in that exchange rate space, where Naira moved from around 750 to around 1,700, 1,800 within a short period of time. But what we have this time, we have that stability. And so we may not see a desperation from the central bank to attract foreign portfolio investors with high interest rates, but we do expect that given the size of the deficit, interest rates will remain elevated around this levels for the rest of the year. However, come February, when the MPC meets, it will review the inflation data, and then they could decide to channel the interest rates in a different direction. We don't expect to see aggressive hikes this year. We don't even expect to see any hike this year. Best case scenario, worst case scenario, we expect them to maintain NPR at 27.5, and that will determine how interest rates will move for the rest of the year.
Okay, but funny you mentioned hyperinflation. The Financial Reporting Council thinks otherwise, but Nigeria is not in that situation. But so far, back to the business, about 1.2 trillion naira has been borrowed so far this year. Now, given the total debt of about 142 trillion as of September last year, there are concerns about debt sustainability here, Caleb. Do you think the high demand for T-bills could encourage the government to overshoot its borrowing plans? And if so, what consequences are we looking at here?
Yeah, so the interest from consumers will not determine the borrowing appetite of the government. What will determine their borrowing appetite is their spending plan and their revenue target. If they reach their revenue targets, for example, if we begin to produce 2 million barrels of oil per day, then they would need to borrow less. If subsidies that have been removed do not get reinstated or do not get reintroduced, they have to borrow less. So the less they have to borrow, the fewer the instruments they will issue. But the more they have to borrow, then they would have to continue to ramp up, and then that'll be to the benefit of the investor, so to say, because at that point, if you're borrowing more, then there has to be a higher price to pay.
Okay. Thank you so much, Caleb Alimi, Chief Dealer, Providence Bank, for your perspective. Great to always have you on the program.
Thank you for having me, Will.